have you been seeing all these headlines lately? Rupee that hits the record lows, or rupee is at 84. Now it seems like every day there's news about the rupee slipping against the US dollar. So let's unpack what's really been happening with the rupee, why it's weakening, and what that means for you and for me as investors. Now, if we look at the bigger picture, the rupee has been on a weak streak against the dollar this year. It's been hovering well around the 82 rupees per dollar mark. So what does it mean when you see that the rupee dollar number on your screen go up? It simply means that you need more rupees to buy $1. That's because the rupee's value has gone down. Or in plain words, it's lost some purchasing power. Now the value of the rupee isn't random. It's all about supply and demand in the currency market. But the Reserve Bank of India, or the RBI, plays a very pivotal role here too. They step in by selling dollars when they think that things are getting too wild to keep the currency a bit more stable. Now let's dive into a major factor, the stock market. Anytime foreign investors pull out their money from the Indian stock market, it means that billions of dollars leave the country. Now this outflow drives down the rupee's value because we are losing foreign exchange reserves with each withdrawal. Now this October alone, foreign investors sold close to $10.5 billion in Indian equities, setting the rupee up for what could be a record monthly outflow. Now, why are these foreign institutional investors or the FIIs selling from the Indian equities? Now, there are two main reasons. China and India's high valuation being the first one. China's economy has struggled to keep up its growth, especially post the pandemic. But recently, they introduced a big stimulus package, easing the monetary policies, ramping up government spending. Now, this has caught the attention of foreign fund managers who are now shifting their focus towards Chinese stocks. Now, at the same time, the Indian stock market is looking relatively pricey or overvalued in comparison to the other emerging economies. So this kind of market volatility tends to hit the rupee in the short term alone. Another key player here is the interest rates. The difference in interest rates between India and the US has a major influence on the rupee. With the US rates rising lately, foreign investors are drawn to higher returns there, which means they are buying more dollars and in turn putting even more pressure on the rupee. Now, with all the geopolitical instability we are seeing from the ongoing Israel-Palestine conflict and the tensions with Iraq, not to mention the Russia-Ukraine war, global supply chains are at risk, and that's pushing oil prices upwards as well. And as in oil prices rise, India being a major oil importer feels the pressure on the rupee again. Alright, so what does all this mean for us? Now, a weaker rupee makes anything imported more expensive, and because India imports a lot more than it exports, the failing rupee raises the cost of products. For anyone considering foreign education or travel, that's going to cost more too. But the biggest hit comes with oil prices, given India's over 85% dependence on crude imports. And here's the question, does the weaker rupee help our exporters? Well, it's a yes and no answer. Sure, a lower rupee makes our exports more attractive as exporters get more rupees for every dollar that they earn. But here's the catch, a struggling global economy means lower demand for our goods. Our merchandise export growth has been pretty muted if you look at this chart. So in the end, further weakening of the rupee isn't exactly great news for anyone. Now, as we move forward, we need to watch several factors like the geopolitical situation, global economic recovery, and India's own interest rate policies. All of these will play crucial roles in determining where the rupee heads next. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.